So final little bit. So basically in terms of resourcing the subject and help for the subject, you can throw the kitchen sink at it. Like there's a ton of stuff there to help you through. The main thing is if you guys have got questions, ask. That's all that we ask. Too many asks in there. AASB.gov.au. They have actually, if you go to that site, you can get all the standards in PDF format for free. You can't bring them into the exam, but if you want to get them without buying the textbook, you can at least see them. CPA Australia have a fact sheet on every accounting standard, and Data Analysis Premium Database has, it may not be that, I mean, it's probably useful for this subject as well, and it will be because there is a bonus assignment which we haven't talked about, and I'll talk about that in a moment. Gives you financial and organisational information for every Australian publicly listed company. Now the very final thing, and I know we've been going on a little bit, the very final thing is, for this subject, we like the idea that, you know, not that everything is high risk, that assessments are often seen as high risk, that, you know, if you do badly in one, or, you know, it affects you quite significantly. What we've decided to institute as a trial, so we'd like to, at the end of the semester, get some feedback on it, is institute a bonus assessment for the subject, which will be 10 marks. So it doesn't mean you can get 110 in the subject, it'll be capped at 100, but there are 10 bonus marks sitting there. And what we'll be getting you to do is to basically research, and it's sort of 10 different things about a particular company. Now, we will be opening up registration for that and providing more details for that next week. And how it will work is between weeks 2 and weeks 4, in your tutorial, you need to go along and just register and say, I would like to do this bonus, I would like to do this bonus assessment. You can choose a company out of the ASX, they'll have a list of the ASX 100. You only get, there's only one company can be used in each of those classes. So if that company has already been chosen in your class, you have to choose another one. You need to take that company and we will then give you small tasks to do each week. And it's just a matter of going off and doing those things. That's all it is. We want you to look at some of the disclosures that they're making. Again, there'll be more information coming out about it next week, but just be aware that that's on the table. Right, looking at accounting regulation. So the need for regulation, who the regulators are, and the regulatory framework. So, who needs accounting regulation? Actually, even more broadly, who needs regulation in the first instance? Why do we need laws, in effect? Accounting numbers are important. It would be wrong to say that they're not. They are important. They are used for decision-making purposes. We do see the markets react to accounting numbers. They are used in a range of contracts, so they are important. We know that. We also know that management know that these numbers are important. Management aren't stupid. You know, they're obviously pretty intelligent people that get there, so they know what's going on. They know that they're important. They also know that they have responsibility to put those numbers together, or at least have sort of sign off on those. They have their own vested interest. As we were talking about before, we assume people are self-interested. They want to do well for themselves. So we put all that together, and we've got this possibility, and I want to stress this, it is a possibility of earnings management. It's not saying that every single company does it. And the reason I say that is, I think in previous semesters when I talked about this, I think people got the wrong idea that pretty much every single company out there is just trying to screw you. It's not the case, but it does happen. And when we're talking about earnings management, we're talking about, you know, it gets talked about as creative accounting, cooking the books, all these sort of things. So what is it? And what creative accounting and earnings management, all these things are, well, this is actually what they're not. If management report efficiently, when you read an annual report, when you look at their profit and see that they have a profit of $100 million, that is as free from bias as can be. That is as true and fair representation of the company as can be. Management haven't gone, oh, we'd like it to be a bit higher, let's make it 110. $100 million is as good a number as they can get. Now, what is important to recognize in all this is that accounting numbers are a model of reality. They are not reality. There are assumptions being made with how these numbers get put together, and if you're in Charles's shoot, there is a phrase he uses, which I will not repeat here, about what he thinks about some accounting numbers. But accounting numbers can be, and this is where the concern about them is they, you know, there are estimates, there are professional judgments being made in there. Some people call them guesses. I don't think that's fair, but you can make them what you want to be. But if they're efficient, then it should be what as best judgment as it can be. However, we know from the previous slide and we know from our discussion earlier today that management have reasons to act opportunistically. Management have not only the reasons to, but they have the means to as well. And by opportunistically, it means they are going to show you in the financial statements whatever they think you want to see. If they have a target, if they have a profit target of $100 million where they get their bonus, and they're going to be at $99 million, you're probably going to see them try to push it up a little bit. If you see them, if William has his debt ratio starting to creep towards 40%, and that's going to breach Thomas's constraint of 40%, William's probably going to try to do something to either bring his liabilities down or push his assets up to make sure he doesn't breach that 40% leverage ratio. That's what we mean by opportunistically. So how do we deal with that problem? Now, one argument is we just don't do anything at all, and we just let the market sort it out. So this is, when you hear, this sort of speaks into a broader debate about whether or not you should have free markets or just regulation. Now, I don't believe in completely free markets, nor do I believe in completely sort of non-free markets. So if you look down the more sort of communist idea of just regulated, you have to do this, 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 and this. Neither of them work. It has to be some sort of regulation in there. But the idea with the free market perspective is we don't need to tell people or tell companies what to present to us because they will have incentives to do that anyway. And this gets at this idea of what's called a market for lemons. And William, you're going to use a lot here at the moment. So we're going back to you as you buying a car. You've now got your $80,000. And we've got to go down and find a car. Now the car that you want, brand new, is going to be more than that. So you're going to settle for second hand. And we're better to go get a second-hand car is to go down Parramatta Road. So he's gone down to Parramatta Road and he's found 2 car dealerships sitting right next to each other. And he's found the car that he wants, the car of his dreams, 2 of them. I don't know how that's worked out, but he's found exactly the same car in 2 dealerships right next to each other. Same color, same kilometers, same, it looks like, everything looks exactly the same model, year, all the rest of it. For all intents and purposes, exactly the same. The first car dealership he goes to, they're both offering it for the same price too, $80,000, which is lucky because that's what you have. The first car dealership has an inspection report from the NRMA saying this car is good to go. The second car dealership does not have anything. Which car would you buy? It doesn't just have to be William to answer this, it could be anyone. Yeah, the first one. You buy the first one because there's more surety about what goes on. So then that begs the question, what would the second guy do? Because if he doesn't provide an inspection report or if he doesn't change anything, he's not going to get sales. The first guy's going to get all the sales and the second guy's going to go out of business. So what are the possible solutions for the second car dealer to do to get sales? Get some sort of warranty. So not even an inspection report, but he could say, if this car breaks down, I back it with a warranty. So absolutely, that's one thing he could do. Sorry, he could just get the certificate and there was someone else who... Yeah, he could just drop the price. So he could sell it for $75. He could get the certificate, so it then makes it completely equivalent. He could provide a warranty which, whilst not a certificate, kind of does the same sort of thing. Or he could just drop the price. So instead of offering it for 80, he could offer it for 75. And then suddenly, William's got to make a decision that do I buy a car for 80 with a certificate or do I buy it at 75 and take a risk without the certificate? And so the argument here is that, it's sort of similar to this, is good companies, if it's a good car, they will want to tell you it's a good car because it is a good car. If they don't tell you it's a good car, your immediate assumption, now apologies in advance if anyone is a car dealer or anyone related to a used car dealer, but used car dealers don't exactly have the best of reps. So if your used car dealer isn't willing to provide you an inspection report, you're probably going to think the worst of that car. And if anything, you'd take it for even less. So this idea is that good companies will tell you what they're doing and how the financials are looking because they're good companies. Bad companies will probably do it as well because if they don't tell you, you're just going to think of them as even worse. So there is an incentive from the market that you will start volunteering information. Now, on some levels that does work, and there is a demand for information, and I think Some of the research, if you go back in the historical research, finds that companies do provide this stuff even without regulation. However, I think it is still useful to have a minimum threshold of this is what you need to provide to us, because there are going to be corners in the market where people do get screwed. So on average, it may be efficient just to let things be. Individual cases probably require regulation to bring it up to a minimum standard, and that's what the regulation is doing. This is what at least we want to see. If you want to provide more, excellent, but this is the baseline we want. So what does accounting regulation do? And effectively limits choice. Now that isn't just accounting regulation. Regulation per se limits choice. For you guys now, and I'm putting it on you guys and not me because I'm never out that late anymore, but for you guys now, if you want to be out in the CBD past 3 o'clock in the morning, I don't think you can do it anymore. It's just not possible. So that regulation has limited your choice about about your actions. It has limited choice about whether or not you can use a mobile phone while driving your car. It limits the choices that you can make. Now, that's not to say people still don't try to make those choices, but there's going to be penalties for that. So with inventory cost methods, there's a whole range of things that management could use if they wanted to, if they had choice. But we've limited that choice in Australia to say you can use first in, first out, you can use weighted average, or you can use specific identification. That is the limit of the choices that you have available to you. And that helps us provide more certainty about how the numbers are generated, because when I look at your company, and when I look at your company, I know that you guys aren't using some way off method for accounting for inventory, and you guys are using something completely different. I know there's kind of one of 2 or 3 methods that you're using, 1 or 2 or 3 methods, and it's much easier for me to compare. But it does still allow discretion because you can pick from a couple of smaller options.